How to invest in a private equity fund. Private equity funds can be the most profitable investments out there, but how do you actually invest in one? In this video, I'm gonna walk you through the entire process step by step. Most people think investing in private equity is complicated or only available to the ultra wealthy. This is not true. I'll show you exactly how to invest in private equity and what to look for before you commit your money. If you've ever wanted to invest in private equity but didn't know where to start, then follow me. I'll show you how to find the right fund, meet the investment requirements, and ultimately make outsized returns. By the end of this video, you'll know exactly how to invest in a private equity fund, what the minimum investments are, and how to choose the right fund to match your investment goals. So what is a private equity fund and how does it work? A private equity fund is simply a pooled investment vehicle where limited partners or investors invest their capital with a general partner, and that capital is used to go buy assets or businesses. The fund manager is typically called the GP or general partner. They are the manager of the fund and they are responsible to go acquire businesses, real estate, alternative assets. Investment periods range from 5 to 10 years, and there's a fixed life to the fund, meaning that at the end of that period, the fund sells off the assets and distributes all the profits to the LPs, the limited partners, also known as the capital investors. So who can invest in a private equity fund? Well, most private equity funds require accredited investors only. At my funds, at Patriot Holdings, the Patriot Fund 1 through 5, we're able to advertise, and I'm able to make this video because my fund is a 506C Reg D compliant fund, and that allows me to advertise. But that also means I have to accredit or verify the accreditation of the investors. What this means is that they are validated by their accountant, their CPA, or they state themselves and fill out a form that they have $1 million net worth, excluding their equity in their primary residence, and or they make $200,000 a year as an individual or $300,000 a year as a married couple. That is for the accreditation requirement. If you do not meet those accreditation requirements, then you can't invest in certain private equity funds. The minimum investments for my fund in particular is $50,000, and this is typical around the private equity world. They will range from $50,000 to $250,000 plus as the minimum investment. So how do you find and choose the right private equity fund to invest in? So first, focus on the criteria. What is the fund investing in? What are they looking for? Focus on the fund strategy. Is it real estate? Is it venture capital? Is it leverage buyouts? Or is it growth investing in more stabilized assets? Second, look at the track record. How long has the fund been in place or the general partners, and what is their track record of wins and losses? Has that general partner been able to drive strong returns in the past? What is the risk profile of the fund? Is it conservative? Is it balanced? Is it high risk? Liquidity and lockup period. Is it a fixed fund or an evergreen fund? If it's a fixed fund, you typically are locked out for 5 to 10 years where you can't get your capital back. In an evergreen fund, meaning it doesn't have a closed period of time that it operates indefinitely, then you may have the option to redeem your shares, but you need to look closely at the fund docs. Fund manager general alignment. Does the GP or general partner invest alongside the limited partners? Is there alignment of interests with the fees? It's important to see if the fund manager is committed to the fund by investing their own capital alongside the limited partners. My firm, Patriot Holdings, is on its 5th private equity fund, and we focus on alternative commercial real estate assets. This is self-storage, mobile home parks, and small bay industrial. These assets have the benefits that all private equity firms look for when buying and improving assets. Self-storage, high demand, low expenses or high profit margins, and very consistent durable cash flows in good economies and bad. Plus, it's highly fractionalized. There's many mom and pops out in the industry that aren't maximizing the efficiency or management of the asset. So we look for growth opportunities to improve advertising, improve physical improvements, improve the customer experience, ultimately driving more revenue and adding value to the properties. Also, we like to aggregate these facilities, meaning we buy them up from different operators or different mom and pops and then bundle them together in a fund and then sell them to a larger institutional private equity firm or a public REIT and get a better multiple or a better sales price that benefits our investors and highly accelerates returns. Next is mobile home parks. They are high margin, meaning high profitability with low operating expenses, because all you're operating is land. We use the land lease community model where we are leasing the spaces, not the mobile homes, and the owner or the tenant of that home rents a space from us in the mobile home community. Private equity firms love this investment model, and they've been getting gobbled up over the last 10 years with institutional or highly sophisticated private equity firms seeing the intrinsic value in this asset. It addresses the serious concern in this country about affordable housing. And it is a very durable asset class because these tenants do not typically move their homes. They're not very mobile, even though they're classified as mobile homes. Small bay industrial parks. Over the last 10 years, industrial has been booming, but recently larger industrial projects have slowed down. But small bay industrial means smaller spaces for smaller tenants like home services businesses, e-commerce, small manufacturers, small logistics companies. These are 1,000 to 10,000 square foot spaces that provide year-to-year or short-term leases to service-based or operational businesses that need a small industrial space. Private equity loves this asset class because there's not a large supply and they are mismanaged or inefficiently managed by owner-operators right now. This is another strategy of Patriot right now, and in 2025, a highly profitable one that we are continuing to focus on by building and buying these types of assets. Also at the Patriot Fund, I like to put my money where my mouth is and invest alongside my investors. I always put in at least $1 million in the $25 million fund so that my capital is at risk with theirs, where I don't make money unless they make money. And this is an important question to ask any general partner that you're considering investing in, is how much skin or how much cash do you have in the game? The investment process, how to invest in a private equity fund. Number one, research and due diligence. Is the fund strategy aligned with what you think will work in real estate? If they can't explain it in 1 or 2 sentences and it doesn't make sense, then how are they going to build it? So understanding what the simple business plan is critical to knowing before you invest in a fund, and do the due diligence. Get the documents and have your attorney review these documents of what are the profit sharing splits, what are the voting rights, what are the timelines of the fund, and do they align with your expectations as a limited partner. Review the private placement memorandum. This is what your attorney is going to review, and this outlines the fund structure, the risk, and the expected returns. This document will share all of the risks, so look at it closely because it discloses, or it's supposed to disclose, everything you need to know about that fund. Accreditation verification. Most funds will ask you to be accredited, and that is a compliance issue in the fund. So be sure to fill out their paperwork and self-accredit, or have your CPA or your attorney give you a letter that validates your accreditation status. Next, sign the subscription agreement. This is the legally binding contract that subscribes you or binds you to the fund. Some investment sponsors or general partners will call the capital up front. So if you commit $100,000, they'll call the capital and you make the full $100,000 investment upon signing the subscription agreement. Other funds will take your capital over time, meaning they'll call the capital over different periods of time where you commit $500,000, but they may only ask for $100,000 over each year of the fund investment, years 1, 2, 3, 4, and 5, deploying that capital over that 5-year period of time, where you're committed and you need to fund that capital call whenever they ask for it, and you're not obligated to put that full $500,000 up front. Once you commit your capital, then you sit back and you wait for distributions. This is the holy grail of why we invest in passive real estate investments. Also, expect tax benefits and getting some depreciation losses. You want to make sure that your tax return, or K-1, can be filed by April 15th. So look out for your K-1s. This is your tax document when you enter into a private equity fund partnership. And then quarterly moving forward, look for your fund updates. These are financials and asset level reports showing the status of your fund. And this is what professional private equity fund managers do. This way, if there's any challenges or issues, they are transparent and upfront, and also they can share wins, and you'll be able to contact them if you have specific questions about your investment. Private equity versus other investment options. Why choose private equity? We're going to look at the difference between private equity investments and stock and mutual fund investments. So the return potential. Private equity has a higher return, 14 to 18% average annual return over the last 20 years. The stock market has lower returns, on average 8 to 10% returns each year. Volatility. It's lower with private equity because it's not traded publicly and the price does not fluctuate. Stocks, higher volatility. It is tied to the stock market. So as it goes up and down, your investment goes up and down. Investment terms, private equity, 5 to 10 year timeline. Investment terms on stocks are daily. You can buy or sell your shares daily and they are highly liquid. Tax advantages. This is a big advantage for private equity because you get depreciation benefits and tax deferral status on your invested capital. You get no benefits from stocks and you are charged capital gains and your dividends are charged at ordinary income tax rates. Private equity funds offer higher returns, tax benefits, and lower volatility, but they require a long-term commitment. When and why should you invest in private equity? If you want higher returns than market returns in the public stock market. If you don't need liquidity in the short term with your capital. If you want exposure to private business acquisitions, inside access to real estate deals, and exclusive investment opportunities that the market doesn't see, then private equity is right for you. If you prefer professional asset management with a hands-on approach of adding value to businesses and industry diversification. Now that you know how to invest in a private equity fund, it's time to learn how to analyze deals that are actually going in the fund. Click on the next video and I'm going to show you how to analyze private equity deals. It's private equity real estate and private equity businesses. This way you know if you're investing in a private equity fund, they're doing the right deals and you can improve your investment returns because you know what's really going on.